artificial intelligence, AI, is transforming the banking industry by facilitating automated processes and improving customer experience. The use of AI in banking has already started, and its impact is evident in various aspects of the industry. 1. Fraud detection and prevention. AI can analyze large volumes of data, including transactions and customer behavior, to detect unusual patterns that could be indicative of fraud. 2. Risk management. AI algorithms can analyze financial data to identify potential risks that may affect the bank's operations, customers, or investments. 3. Customer service. Banks can use chatbots powered by AI to handle customer inquiries and provide personalized recommendations, resulting in improved customer experience. 4. Predictive analytics. Banks can use AI algorithms to analyze data and forecast future market trends, enabling them to make informed decisions about their investments. 5. Personalized marketing. By using AI algorithms to analyze customer data, banks can offer personalized experiences such as targeted promotions and products. 6. Credit scoring. AI algorithms can assess a borrower's creditworthiness based on their financial history and other factors more accurately than traditional credit scoring models. 7. Anti-money laundering, AML. By analyzing transactions for suspicious activity patterns or anomalies, AI can help banks meet regulatory requirements for anti-money laundering, AML, compliance. 8. Wealth management. Wealth managers can use AI tools to automate portfolio management tasks such as asset allocation and rebalancing. 9. Investment analysis. Banks can use AI algorithms to analyze market trends when deciding where to invest their own funds or advising clients on investment opportunities. 10. Trade finance. By leveraging machine learning algorithms, banks can streamline trade finance processes such as document verification and processing trade finance applications faster. 11. Asset management. Asset managers can use predictive analytics tools that incorporate machine learning models to identify patterns that may signify investment opportunities. 12. Loan origination. Banks can use AI-powered tools to automate the loan application process, reducing the time taken to approve applications and minimizing errors. 13. Customer acquisition. By analyzing customer data, AI algorithms can help banks identify potential customers and create targeted marketing campaigns to acquire new ones. 14. Chatbots. Banks can deploy chatbots that use natural language processing, NLP, to assist customers with common queries or perform simple tasks such as checking account balances or transferring funds. 15. Virtual assistants. Wealth managers can use virtual assistants that leverage machine learning models to offer personalized financial advice to clients. 16. KYC. Know Your Customer. Banks can use AI algorithms that analyze customer data and verify their identity in real time, ensuring compliance with KYC regulations. 17. Credit risk analysis. Banks can utilize AI tools for credit risk analysis that enables them to identify high-risk borrowers and assess their creditworthiness more accurately. 18. Portfolio optimization. Asset managers can leverage AI-powered tools that utilize machine learning algorithms to optimize portfolios based on various factors like assets, risk tolerance levels of investors, etc. 19. Regulatory compliance. By leveraging AI tools for regulatory compliance, banks can ensure compliance with various regulations such as GDPR, PSD2 and other local laws related to banking operations. Artificial intelligence, AI, is advancing rapidly and has become an integral part of the banking industry. Financial institutions are increasingly using AI to enhance customer experiences, streamline processes, and reduce costs. However, the use of AI in banking also comes with potential risks that need to be understood and managed effectively. In this technical instruction video, we will explore some of these risks and provide guidance on how to address them. One of the key risks associated with using AI in banking is data quality. AI algorithms rely heavily on good quality data to make accurate predictions or decisions. If the data used by the algorithm is incomplete or inaccurate, the results produced by the algorithm may also be flawed. This can lead to incorrect decisions being made based on faulty predictions, which can have serious consequences for customers and financial institutions alike. To mitigate this risk, it is important to ensure that data used by AI algorithms is accurate and up-to-date. Banks should invest in data management systems that are designed to detect errors or inconsistencies in data sets. They should also establish robust data governance policies that ensure all data is collected, stored, processed, and analyzed ethically and transparently. Security and privacy. Another major concern when it comes to using AI in banking is security and privacy. Financial institutions deal with sensitive customer information regularly, such as bank account numbers or social security numbers, which if leaked could result in heavy losses for both customers as well as banks. AI requires access to large amounts of customer data to train algorithms effectively. This makes it a prime target for cyber attacks or hacking attempts aiming to steal sensitive information about clients or disrupt services provided by banks. To minimize these risks, financial institutions must prioritize security measures such as firewalls, intrusion detection systems, IDS, encryption methods, etc., so that potential threats can be detected early on before they cause any damage. Bias. Another risk associated with using AI in banking relates to bias, both intentional and unintentional. Biases can creep into AI algorithms in a number of ways, from data selection to algorithm design. For example, algorithms that are trained on historical data may reflect biases of the past, leading to discrimination based on gender, race, or other characteristics. To reduce bias in AI, financial institutions must be aware that it exists and take action to address it. This requires a thorough understanding of how AI algorithms work and how they can be biased. Financial institutions should invest in ethical AI frameworks and conduct regular audits to ensure that their algorithms are unbiased. Regulatory compliance. Finally, using AI in banking comes with regulatory compliance risks as well. Financial institutions are subject to various regulations such as the General Data Protection Regulation, GDPR, or the Payment Card Industry Data Security Standard, PCI DSS. These regulations require financial institutions to implement measures that protect customer data, ensure transparency in decision-making processes, and meet certain compliance standards. To mitigate these risks, banks must ensure that their AI applications comply with relevant regulations. This requires ongoing monitoring and assessment of regulatory requirements as well as implementing necessary controls before deployment. In this technical instruction video, we will explore the benefits of implementing AI in banking. 1. Improved customer service. With AI, banks can provide customers with personalized experiences that cater to their unique needs. This includes offering tailored recommendations, personalized financial advice, and more. By analyzing customer behavior and transaction data, AI can also help banks identify potential issues before they become major problems. AI-powered chatbots are another example of improved customer service. They can answer customer queries instantly, 24/7, without any human intervention. This reduces wait times and enables customers to receive quick and accurate responses to their inquiries. 2. Fraud detection. Fraud is a major problem in the banking industry that costs billions of dollars every year. With AI, banks can detect fraudulent activities faster and more accurately than ever before. AI algorithms can analyze massive amounts of transaction data to identify patterns that may indicate fraudulent activities. They can also use machine learning models to detect anomalies in customer behavior that may indicate fraud. 3. Enhanced risk management. Risk management is crucial for any financial institution. With AI, banks can analyze vast amounts of data from multiple sources to identify potential risks and take proactive measures to mitigate them. AI algorithms can analyze market trends, credit ratings, and other indicators to predict future risks accurately. Banks can use this information to make informed decisions about loan approvals or investment portfolios. 4. Cost reduction. The implementation of AI in banking systems significantly reduces operational costs while improving efficiency. For instance, AI-powered chatbots reduce the need for human customer support teams, reducing labor costs for banks significantly. Banks are also using AI-powered algorithms for credit scoring assessments and risk analysis instead of hiring expensive experts or consultants for such tasks. This reduces the need for staffing and training, ultimately reducing operational costs. 5. Speed and efficiency. AI can process large amounts of data faster than humans, making it a valuable tool in the banking industry. For instance, AI algorithms can analyze customer data to develop customized offers or recommend products in real time. This means customers can receive personalized recommendations instantly, without any delay. AI also improves the speed and accuracy of loan processing through automation. It can analyze vast amounts of data in a matter of seconds to assess creditworthiness and identify potential risks. As a result, banks can provide customers with faster loan approvals and disbursements. 6. Compliance. The banking industry is highly regulated, with strict compliance requirements that must be met to avoid penalties or legal repercussions. AI helps banks maintain regulatory compliance by automating monitoring and reporting processes. For instance, AI algorithms can monitor transactions for suspicious activities to comply with anti-money laundering (AML) regulations. It can also help ensure that banks comply with Know Your Customer (KYC) regulations by analyzing customer data for identity verification. Conclusion. The integration of AI in banking systems has revolutionized the industry by improving customer service, enhancing risk management, reducing costs, increasing speed and efficiency, detecting fraud more accurately and complying with regulatory requirements more effectively.